Micron Technology Inc. is trading at $1,012.25 per share during today's intraday trading session, marking a massive move of 9.61% upward on explosive volume. The immediate catalyst that is shocking the option markets right now isn't just the sheer velocity of this breakout, but the structural transformation in how global data center giants are negotiating contracts. While everyday retail participants are chasing basic headline numbers, large institutional desks are noticing that major tech conglomerates are quietly locking into 3-year and 4-year binding supply agreements for memory hardware, essentially treating high-bandwidth computing architecture like rare earth elements rather than commodities. This is a complete departure from the historical cyclicality that usually breaks this industry every few years, which means the traditional playbook used by mainstream financial analysts is effectively obsolete. The general expectation among most investors when looking at a semiconductor designer like this is that memory chips are a brutal boom-and-bust retail business. The common belief is that whenever prices rise, supply increases, the market gets flooded, and the underlying equity collapses. However, the reality we are observing right now is that the physical complexity of producing advanced processing memory has created a supply wall that cannot be overcome by simply spending cash. By recognizing that high-performance infrastructure is currently undersupplied by 30 to 50% across the entire cloud sector, you begin to see why premium research institutions are aggressively upgrading their internal projections. When you look closely at today's trading volume, institutional block trades are dominating the order flow, completely reshaping the technical setup of this asset. Looking across popular online investing platforms, this massive liquidity surge is catching the attention of self-investing individuals who are scanning the biggest gainers of the week. This isn't just retail momentum pushing a ticker around. The depth of the bids suggests that systematic allocation models are treating this company as an essential foundation for the entire decentralized processing ecosystem. For those using an online investment platform or navigating various investing sites to find standalone hardware opportunities, seeing a legacy manufacturer break out like this is a stark reminder that pure compute power cannot function without massive storage pipelines. If you analyze the recent structural patterns on the Advanced Interactive Brokers platform, you can see that the options chain is pricing in a completely different tier of implied volatility, with a massive concentration of open interest in deep out-of-the-money call contracts expiring around the upcoming fiscal third-quarter earnings report on June 24. This reflects a major shift in how hedge funds are managing individual brokerage exposure. They are no longer treating memory suppliers as secondary plays behind massive logic processors, but rather as co-equals in total hardware requirements. People executing strategies via a standard Robinhood app or managing a portfolio through self-investing channels are seeing daily swings that used to take 3 months to play out, all because the industry is experiencing a severe pricing reset. Comment below how many shares of Micron Technology Inc. you currently hold in your portfolio. This dramatic escalation in market valuation is directly tied to the fundamental shift in the company's product line, specifically away from classic legacy consumer modules towards complex data center silicon. For a long time, the public image of this firm was bound to basic consumer products under consumer brands like Crucial, which was completely phased out early this year to fully prioritize high-margin enterprise orders. This structural change is visible when evaluating the operational metrics available on premium institutional dashboards or via comprehensive tools like Schwab Intelligent Portfolios. The capital expenditure efficiency has improved dramatically because they are no longer spending vast resources marketing to the retail gaming or custom desktop assembly space. Instead, their entire output for the next 18 months is pre-sold directly to hyperscale cloud developers through those long-term strategic customer agreements. To truly understand why the expectation versus reality dynamic is creating such an intense squeeze, you have to look at the massive capital investments being deployed inside the United States. Following the financial backing provided by domestic industrial manufacturing initiatives, the company has broken ground on major new facilities, including a $15 billion complex in Boise, Idaho, alongside a colossal $100 billion multi-phase expansion project in Clay, New York. Retail traders browsing simple stock lists on a basic Robinhood stock trading setup often overlook the multi-year lag between breaking ground on a manufacturing fab and achieving commercial wafer yields. The reality is that these domestic facilities will not bring meaningful supply online for quite some time, meaning the current supply crunch is structurally locked in, leaving the company with near total pricing leverage over its enterprise client base. This dynamic becomes even more apparent when you compare the underlying metrics across the board with other tech assets like Tesla stock, Apple stock, or Nvidia stock, which all rely heavily on memory efficiency to run their latest edge AI software systems and autonomous hardware models. For example, modern advanced graphical processing units require dedicated high-bandwidth configurations to prevent localized data bottlenecks, meaning every single high-end logic unit shipped globally requires an accompanying high-margin shipment from a specialized memory manufacturer. When retail participants manage their accounts through legacy institutions like Fidelity Investments or utilize specialized tools within a Fidelity brokerage account, they often look at trailing valuation multiples and assume the equity is overextended. But if you analyze the massive jump in enterprise software requirements, you realize the total addressable market has expanded at a rate that standard backward-looking economic models completely fail to capture.
This structural leverage is precisely why professional asset managers using premium platforms like Interactive Brokers Trading are maintaining heavy overweights in the sector despite the massive year-to-date run. The operational execution under the current corporate leadership team has been entirely focused on maximizing yield on advanced modes, such as their newly initiated advanced production line in Manassas, Virginia, which represents the most sophisticated architecture manufactured on domestic soil. By locking in these technical milestones, the company has managed to structurally elevate its gross margins towards record territories, completely defying the historic cycle that typically punishes memory fabricators during periods of global macroeconomic tightening. If we look back at the older reports in the historical business model, the company was founded in late 1978 in Boise, Idaho, initially operating as a humble semiconductor design consulting firm before transitioning into dedicated manufacturing with its first wafer fabrication unit in 1981. Over the decades, it navigated brutal global price wars against international consortia, surviving by aggressively consolidating smaller players and building critical joint ventures, such as its early collaborations with major domestic technology developers. This long history of operational survival built a highly resilient capital structure, allowing them to weather severe downturns by maintaining a lean debt profile and focusing entirely on core engineering. Today, as one of the few dominant global players left standing alongside major South Korean competitors, the company has transformed from a volatile component supplier into an indispensable bottleneck for the entire global technology landscape. Looking ahead, the tension between what the market expects and what reality will deliver centers entirely on the sustainability of this premium pricing environment. The bearish case, often presented on basic investing sites, suggests that as competing manufacturers ramp up production of their own advanced architectures, global pricing will experience a sharp correction, reversing the operating leverage that is currently boosting free cash flow. However, the contrarian view indicates that the design complexity of next-generation high-bandwidth systems is so severe that competitor yield rates are lagging significantly behind internal projections, ensuring that the market remains structurally undersupplied well into the final years of the decade. For investors using a SOFA active investing platform or reviewing curated asset allocations via a SOFA robo-advisor, managing this specific headline risk is going to be the defining factor in portfolio performance over the next 12 months. The primary operational risk that could disrupt this structural thesis revolves around localized supply chain disruptions or sudden shifts in international trade frameworks, given the highly integrated nature of global hardware assembly. While the front-end wafer fabrication is increasingly shifting towards domestic hubs, a significant portion of the back-end packaging, testing, and component assembly remains heavily anchored in advanced hubs across Malaysia and Singapore. Any unexpected regulatory friction or logistics bottlenecks in these regions could immediately choke off the flow of finished products to key cloud enterprise clients, creating a short-term revenue mismatch despite overwhelming structural demand. This is why sophisticated traders using an advanced interactive brokers platform closely monitor regional container shipping data and international factory activity indicators rather than just waiting for domestic corporate updates. Ultimately, the market is currently witness to an intense struggle between historical valuation models and a completely unprecedented structural shift in enterprise demand. The old expectation was that this asset would always remain a volatile trading vehicle bound to the brutal realities of hardware oversupply and cyclical margin collapse. The unfolding reality is that the absolute necessity of high-bandwidth memory architecture has turned this company into a core piece of international infrastructure, giving it unprecedented pricing power and a clear visibility runway that stretches out from multiple fiscal years. For the individual investor navigating this landscape through self-investing tools or a standard brokerage app, success will depend on ignoring the superficial noise of daily price swings and focusing entirely on structural yield milestones, capacity commitments, and the deep operational metrics that dictate long-term market dominance.